And so as things unravel, of course, the pressure, the combination of declining confidence and peak debt is a very bad one. My question really is, does it take the Fed, or would it find the weak spot anyway, sooner or later?
In today's video, billionaire and legendary investor Jeremy Grantham blames the U.S. Federal Reserve for creating a bubble in asset prices. He believes that it has a long way to go before it's fully deflated. As a result, stock prices may not reach bottom until late next year.
What are your general views about the recent banking crisis, and what can history tell us of the events unfolding in the banking system and, I guess, the overall markets today?
I was reminded of the old aphorism that the Fed keeps on tightening until something breaks, and in a situation like this. And it reminded me of a conclusion that I had come to on the study of the great bubbles, the handful, the 5 or 6, including Japan in the last 100 years, because it seems to be the same. When you come down from a high, the ultimate sugar high of a super bubble, almost infinite optimism, a belief that good things will go on forever, that record profit margins, etc., etc. And it's always, the bubbles always form at the end of a long, heroic economy, and everything in the garden is perfect. And it always has taken cooperation on the part of the Fed and the administration. So everything is perfect. And then when something pricks that confidence and it begins to leak out, there is a long way down to go from the peak of optimism to at least mild panic, if not severe panic. It's a long drop. And at the top, people have always, in their confidence, have always expanded their debt levels. So they're always at or near the all-time peak in 1929 or 2000, the housing bubble and so on, and in Japan in 89. And as they were this time you had record levels of debt to GDP all over the world, but certainly including the US. And so as things unravel, of course, the pressure, the combination of declining confidence and peak debt is a very bad one. My question really is, does it take the Fed, or would it find the weak spot anyway, sooner or later? And maybe the Fed raising rates accelerates the breaking point. And I think of it as like water behind a dam. You're never going to be able to predict which brick goes first. In fact, you should expect the unexpected. By its very nature, it's a complicated financial system, a complicated economic system, and you build up the pressure and you build up the pressure as your confidence comes down and the debt begins to hurt, and particularly if the Fed is raising rates, and then something blows. And each time it seemed to be unexpected. Who imagined Bear Stearns would go, hey, the bear, as we used to call them, they were the guys that always inflicted the nasty paper on other people. And when the music stopped, they always had one of the chairs. So when Bear Stearns went in 2007, it was a major surprise. And Silicon Valley, until you think about it and look at the balance sheet, it did appear to strike the world as a complete surprise. And maybe that is my point from 60,000 feet, is that is the nature of the beast. You should expect that the first thing that goes will, generally speaking, be a surprise. And then how it cascades is virtually unknowable. But let it be said, after the handful of the great bubbles, there has always been a recession. If people behave well, the leaders are sensible, it's a mild recession. 2000 was about as mild as it comes. If they behave very badly and get unlucky, like 1929, you get a depression. If they behave badly and refuse to regulate subprime instruments in the housing bubble, where Larry Summers and the boys lent on Brooksley Bourne, who had the legal right to control subprime, regulate it. On the ground, you didn't need to regulate banks. They were, by their nature, capable of self-regulation. This was the Federal Reserve levied at the SEC and Larry Summers arm wrestling to make sure that they were not regulated. I love to bring that up because I call those guys the Teflon men, and it doesn't seem to stick with them. They brought the system to its knees on the mistaken belief that capitalism could self-regulate. And what a horror show it was. And anyway, here we are back again, and we're going to find out how good the regulations have been since the housing bust, how effective the weaseling of the corporations was to push it back. We all know now how Silicon Valley CEO personally joined the lobby really to roll back the regulation so that they could be unregulated. On the supposition, once again, somehow that capitalism is responsible enough to regulate itself. Well, it just ain't so. And capitalism needs a policeman at the corner of Broad Wall, as FDR said. And in recent times, some of the policemen have been taking time off or being regulated off their beat.
Would this be any indicator in your mind that we are, say, somewhat towards the end or more like halfway?
People make a big mistake to average bull markets and bear markets. This is not about that. This is about something quite singular and different that happens on rare occasions in the great bubbles. The 2.5 sigma ultimate euphoria episodes. It's like a phase change. People go from fairly sensible behavior in an ordinary bull market to absolutely crazy as could be in these great bubbles. And throw the rest of the data away and look at the bubbles, and the data is clear. First of all, they're always easy to spot, and it is always claimed that they are not, but they stand out in terms of the data on the market like a Himalayan peak out of the plain. 2.5 standard deviation events of the kind that occur every 50 to 100 years, these are not hard to spot. 1929, you had to try to miss it. 2000, Lord knows you had to try. It went to 35 times earnings, beating everyone on the head with a hammer. The housing bubble was even bigger than that. The U.S. housing bubble in 06, that was a 3 sigma. That was literally over a 100-year event. It had never happened before. Most unlikely. It took the undivided attention of Greenspan and Bernanke pushing interest rates down to finally get the entire U.S. housing market to go into warp drive simultaneously. Famously, it had been diversified before that. It would bubble in Florida, crash in Chicago, and so on. So it never happened until it got their undivided attention. And so just concentrate on these few. They always have a recession, and when they want to take their time, they really take their time. Most of the decline in these great bear markets only happens after the first interest rate cut. So you tell me when the first interest rate cut is, and I will tell you when the second half of the pain is going to start. And it would be unlikely from a historical point of view that this would not run, this financial and stock market event would not run deep into next year. And that's what it looks like. It's not hurrying. But let me bring up another point on your chart. We have forgotten to inflation adjust because we haven't had inflation for 20 years. In the old days, all data like this, everything you read in The Economist, etc., was always inflation adjusted. We have had, for example, over 10% inflation. The market isn't down 15%. The market is down 25%. In the housing bubble, there was no inflation. In 2000, there was no inflation. You can't compare this one with 10% inflation with that one that had a couple. And 25% is a pretty decent down payment on this bear market, I would say. The passage of time against a market that has a trend line and in an economy that has inflation, the passage of time is pretty painful. If you even stay flat, you are losing money at a decent speed. And people have forgotten that. The blunt truth here is I don't really care. I try and concentrate on what I consider the realities, which are profits and growth. And I assume that if you're patient, that the paper side of it will wash through the system. And we had a very obvious first phase of the bubble. We pricked the confidence. It's easy. All you have to do is shake that complete and absolute euphoria. We did that. It popped nicely. Then you have a classic bear market rally. And we knew from the beginning, didn't we, that we would have more buy the dip this time than almost ever before because of the $1 trillion plus lurking around in the piggy bank from COVID stimulus. And from the behavior of the meme stocks, we knew this was not going to melt away too quickly. And so we had the spectacular rally, and we may very well have more. And then you get into the third phase, and that is the fundamentals. And that's the difficult one. How long and how painful will the actual reality, the adjustment phase be? How badly will the economy slow down? How badly will profit margins shrink? Let me point out the most genteel one was 2000. We had a very mild recession. We've never had anything like a soft landing, but that was the closest. That was the least hard landing. And what happened? NASDAQ went down 82%. S&P went down 50%. Real estate was cheap. It was not involved. The bond market was cheap. It was not involved. Everything that was favorable could be favorable. And still it droned on for 3 years. And the NASDAQ went down 82%. That is what I'm interested in. Profit margins got hammered and the growth rate slowed down moderately. In the housing bubble, the GDP slowed down even more. Profits basically disappeared completely. 1929, of course, was even worse. So we're going to have an unknowable bad time. It will depend on how effective the administration is and so on. But the truth is, we come into this with very high profit margins. We come into it with a form of capitalism that was raising prices for the first time ahead of the workers, so that in unexpected inflation, very quickly profit margins went up and real wages went down. This is not what happened in the 70s, I can assure you. Profit margins went down and real wages went up. But this is a corporate system that we could talk about, which is really quite interesting. The American corporate system has developed a style that makes it almost possible to break the law legally. The way to make a lot of money is to get on the telephone, call up your competitors, and withhold production. The bad news is if they catch you, you go to jail. And what we have today, increasingly now for 20 years, is a style of capitalism where the stockholders are leaning on the corporations to take it easy on capex. Why? I mean, basically, it generates an economy of mild shortage all the time. You want to make money, that is the world to live in. So mild shortage all the time, pressure on the workers. In the good old days, they always built an extra plant. It was the bane of stock analysts like me in the 60s and 70s. Whenever things started to improve, 8 paper companies would all start to build a giant plant at the same time, and they would crash the prices. It was great for jobs, great for GDP growth, pretty good for productivity, terrible for stockholders. And now we don't. The capex has dropped as a fraction of the total pretty steadily for 20 years. The degree of concentration, or monopoly if you prefer, has risen pretty steadily for 20 years. And it's all legal because it's the stockholders breathing down your neck saying, dudes, buy your stock back. Don't build a risky new plant. It might work well. It might be mistimed. In any case, it's risky. Better to wait and see which of the hundreds of VC firms work out well, and then grab 1 or 2 of the best ones. It's a capital transaction, doesn't go into the income statement, all that dangerous volatility that you used to have associated with your own endeavors, you can now smooth out and wait to see who wins. In any case, so the profit margins have risen steadily. And even in adversity, they are good. Even in COVID, they're good. Even as the economy slows down, even as inflation unexpectedly bursts on the scene, you suddenly find yourself, oh, what a surprise, in a world of mild shortage. Any surprise, and we are short capacity. And this is wonderful for profits, terrible for the economy, terrible for equality and the wage rates of the workers, who basically are still stuck back in the level of hourly rate adjusted for inflation of 1975 to 1980. That is not an exaggeration. Check it out. And yet we have grown as fast as other countries, about, say, France. I like to say whose bottoms we have been apparently kicking for the last 40 years, if you read Business Week, because of Eurosclerosis, because of too much government control. Their average hour worked has increased its remuneration by 160%. Japan by just shy of 100. The dopey Brits by 60 or 70%, and the hard-driving capitalists in the US, less than 10. I mean, basically, our workers have been royally screwed, have not participated in the substantial productivity since the mid-1970s. And the main culprit is now completely legal. That is the stockholders bullying management into doing what management always wants to do anyway, which is live in a world where you control everything, you buy your own stock back. And Warren Buffett has said some very interesting things about stock buybacks recently. Like anyone who suggests there's any damage done as an enumerator or a villain. Of course, he did say all buybacks. Anyone who says all buybacks are damaging. Of course, that word all can be used to make, there's always some exception. There's always some part of anything that is useful. But what stock buybacks do is facilitates this world that I'm talking about. You don't want to do any capex. You want to live in a world of shortage. So you just buy your stock back instead of building a new plant. And let me just point one thing out to people who think it's identical to a dividend. When you pay a dividend, you distribute it evenly between your most enthusiastic stockholders and the one who is disgusted with you and is about to sell you on Monday morning. A stock buyback does not do that. The stock buyback says, who is the least enthusiastic about my stock? Here's the pseudo dividend. You hand him cash and you take his eager stock. You are constantly retiring the least enthusiastic shareholders. And if you think that that does not remorselessly push up the price of stocks, you are not exactly innumerate, but unimaginative. Of course it does. Secondly, it was illegal for the first 15 years of my career and forever before that, since FDR, because they argued that the insiders in the company knew everything. And going out into the market and buying from the uninformed was stock manipulation. How ridiculous. How ridiculous to think that the corporate insiders know more than you do as an institution buying from the outside. Of course they know more. Of course it is facilitating stock manipulation. And in my opinion, of course, it should be illegal. People say, well, it's the same as dividends. Well, in that case, whoopee, pay a dividend. And nothing has changed. You pay out a dividend, I'm happy, and apparently you're happy. And Warren will have to pay some taxes. I'm sorry about that. But it is much healthier in the long run for the total economy to have corporations paying simple dividends. And then some of the incentive to buy stock back rather than build a new factory disappears, and there will be a little bit more growth in capex, which is really done badly. GDP growth has slowed, in the US for the last 30 years as this new fashion came in. Productivity has irregularly, but obviously slowed down. The state of US capitalism is not that healthy, I believe, with the exception of the VC industry, which is still pretty good.